This is Andrew Stotz of A. Stotz Investment Research to talk about world-class benchmarking. I'm going to explain the measure that I focus on, which is profitable growth. And that's what matters to me when I'm looking at the fundamental performance of companies. So I focus on profitable growth, which is at the top of this triangle. You'll come to know my world-class benchmarking measure by this triangle, and later we'll talk more about it, but it looks like this. Now let's get a little bit of a summary of what I'm about to show you. The first thing is that I'm looking at a global universe of about 27,000 companies across 10 different sectors. The second is that I try to rank companies on their profitable growth measure from 1 to 10 against all their peers of a similar size. So this is not a measure of one company against its immediate peer, but against the whole group or sector. What I've found is that share price performance of superior profitable growth companies have beaten peers. Also, companies with large improvements in profitable growth rank have yielded outstanding share price returns. And I'm going to show you that the bottom of the triangle shows the strengths and weaknesses of the company and builds up to that profitable growth ranking. So profitable growth is what matters. I'm going to explain why profitable growth matters, as well as the classifying of peer groups and then how to read the triangle. So let's get into this. Why does profitable growth matter? Well, because superior profitable growth companies' share price or valuation beats their peers, right? And what I've been able to find is that a large improvement in profitable growth will give large or outstanding returns relative to the other companies. So here is some academic style study that we've recently done to go through the detail of this. This study started with 19,500 companies across the world. And basically, originally we started with 93,000, but there's a lot of issues like warrants and other types of issues that we eliminated. And then we ended up removing financial companies and companies with a market capitalization of less than $50 million, which left us with 23,500 non-financial companies worldwide. We removed 4,000 stocks that did not have the fundamental data needed to calculate the A. Stotz profitable growth metrics. And this left us with about 19,500 stocks listed on different markets across the world. Again, this is from 1995 to 2015. So the methodology of how we did this study is we grouped all companies by size within the 10 different sectors. Large, those are companies with either assets or sales of more than 700 million. Small, companies with either assets or sales of less than or equal to 130 million. And mediums, which are companies that were in the middle. If the sales and assets for a company showed conflicting results, we let the size of the sales determine the group that the company would go into. Also, a company that had sales of a large company but assets of a medium one were classified as large, and a company with medium sales and large assets we classified as medium. The remaining 1% of all companies either had large sales and small assets, or small sales and large assets. They were classified as medium-sized companies. So to continue on, first we calculated the two components of our A. Stotz profitable growth measure. First is profitability, which is net income divided by the average assets outstanding in a business. And then there's the growth in earnings per share, which is the current year's EPS minus the prior year's EPS divided by the absolute value of the prior year's EPS. Now we rank the companies in deciles on our combined profitable growth score relative to all their sector peers of a similar size across the world in each year from 1995 to 2015. We calculated the 1 year stock price return from the prior year's reporting date. For example, for December 2013, if we assume that the company announced its financial results, so if it was a December close, so if they announced their results by March 2014, then its 1 year share price performance return was from March 2013 to March 2014. Then we calculated the simple average price return for each profitable growth decile and the compound annual price return during the 1995 to March 2015 period. To eliminate outliers, we excluded 1% of the observations, which meant stocks that had a price change of more than 500% or less than minus 85 in any 1 year. We repeated this process for each size group, large, medium, and small, and looked at the results separately. The final number of companies included in each size group, after excluding all companies that didn't have year-end in December and adjusting for outliers, we ended up with 3,600 companies that were large, 4,400 that were medium, and 4,000 that were small. So a total of 12,000 companies. So what was the result that we found? Well, we found that for large companies, the superior profitable growth companies beat their peers. In other words, the higher deciles, which are to the left, which show best for number one, yielded higher share price returns versus the lower deciles. Over the time period studied, even the worst deciles showed an average annual positive return. But the decile with the best profitable growth returned 15 times the higher annual return than the worst. So 31% average annual price return versus only 2 for the worst. Now, if we look at medium size, we find roughly the same thing, right? The higher ranked deciles yielded higher returns. We also saw for medium-sized companies, the difference between the best and worst were even more significant than for large. The 2 worst deciles showed actually a negative average annual return. And then if we look at small, we find that, again, the higher ranked deciles yielded higher returns. We also see that the profitable growth rank shows a clear relationship with share price, and a high rank means a high share price, and a higher profitable growth rank means a higher value of the business ultimately. This holds true whether it's large, medium, and small size companies, though it's more extreme in the case of small or medium sized companies. Now, part 2 of this methodology is we analyze the share price performance of the companies that changed their profitable growth rankings in each size group. We calculated the change in decile ranking from the prior year in each group. For example, if the company was ranked in the 3rd decile this year versus the 4th decile last year, the company would have improved by 1 step. Then we grouped the companies that showed no change in decile rankings as the starting point. After that, we grouped every company that showed an incremental 1, 2, or 3-step improvement into another group. From this, we ended up with 7 groups, each containing a different number of companies. Then we calculated the simple average price return of each group each year, assuming that we started to invest in each group every year in March. So from March 1995 to March 2015, then we compounded the annual returns for each group. So what did we find? Well, first, large companies with large improvements in profitable growth yield a higher outstanding price return. So we can see that the profitable growth group that improved by 7 to 9 steps returned 33% per annum, more than double the return compared to the group that showed no improvement. The profitable growth group that fell 7 to 9 steps in decile rank displayed a slightly negative price performance. Now, if we look at medium-sized companies, what we find is it looks similar. But the profitable growth groups that improved by 4 to 9 steps returned 31%. So in other words, even if a company made less of an improvement but still made a good improvement, they would get equally ranked by the market. The profitable growth ranks that fell 4 to 9 steps in decile rank displayed a negative price performance, losing on average 4 to 5%. And the market is less discerning, meaning strong improvements almost always equal strong share price performance and vice versa. Finally, with small companies, the group that improved 4 to 6 steps returned more than the group that improved 7 to 9. It seems like the market was more skeptical to extreme improvements for small companies. The market rewards improvements in profitable growth, and this holds true for large, medium, and small companies. So what have you learned about why profitable growth matters? First of all, results from our research looking at 12,000 companies across the world, we show that share price performance of superior profitable growth companies beat their peers. Also, companies with large improvements in profitable growth rank, yield outstanding share price returns. This holds true for both large, medium, and small companies, for all three groups. So now let's talk about classifying the peer group. First, we ask the question, what is the size of the business? Then we say, what sectors does the company operate in? So what is the size? Size does matter because small companies tend to grow faster than large. So first, we group the companies into one of the following three size categories: small, medium, or large. Then, large firms, as I mentioned before, are either assets or revenue more than 700 million. Small firms, either assets or revenue less than 130 million. And medium-sized firms are either assets or revenue between the large and small. Now, there are 10 sectors across the world. No two companies are alike, but some are more alike than others. We use the GICS codes developed by MSCI and Standard & Poor's. Currently, there's 10 sectors and 24 industry groups, and we rank companies within one of the 10 major sectors. So we have to ask, what sector does the company operate in? Well, there's consumer discretionary, such as car companies, consumer staples, such as food and other household supplies like Walmart's products. There's energy, there's healthcare, there's industrials, there's information technology, materials, real estate, telecom, and utilities. So what have you learned about classifying the peer group? First, we classify the businesses based on its size, meaning small, medium, or large. A large company should not be compared against a small company and vice versa. We then classify the company into a global sector. A consumer company should not be compared against an energy company, for example. The company is then assigned a 1 to 10 ranking within its size category of its sector. So now let's talk about how to read the triangle. The top of the triangle is what matters. The results at the top of the triangle are explained by the results below. Level 2 and 3 explains what's really driving the profitable growth. So let's talk about the top of the triangle, and basically remember that how we do this is we look at the ranking of a company, in this case in the year 2011, and we rank from best to worst. And let's just say that this is a subject company that's ranked at number 5. The company is grouped, all the companies in that industry are grouped into deciles based on their financial performance or their profitable growth score. Now, we look at this and we see that actually we do more than 1 year, we do 5 years, and we do PTM, prior 12 months or the past 12 months, and from best to worst again. So in this case, the company was ranked in the 4th decile in 2014, and then it improved in the past 12 months to number 2. So we can see this company went from 2011 5, 2012 4, which was an improvement. It went back down in 2013, then it improved in 2014, and in 2015, or the prior 12 months, it improved to a ranking of 2. So we put that company's 1 to 10 rank into the triangle, so we don't need this thing anymore. We can just put it in the 5, 4, 5, 4, 2, and now we get the top of the triangle, which is profitable growth. Now, profitable growth comes from a combination of the company's score on profitability and growth. And profitable growth is measured by these two measures below. Now, what we want to think about is that this profitable growth drives truly sustainable long-run value in the business. Reduced asset-driven growth, earnings growth, is great because this decreases the need for new capital injections. So let's review the first driver, which is profitability, on the left. If we look at profitability, it means generating more profit from the assets in place. It is the profit divided by assets, or return on assets. Getting more out of assets means the company needs less capital. But beware, very high profitability with no growth is not sustainable. So let's review the second driver of profitable growth, which is EPS growth. EPS growth is the annual % change in profit per share. This shows that customers want the company's product and that it can be produced profitably. Again, beware, high growth but low profitability is often a waste of money. So now we can see the triangle with one more layer below it. We can see that the profitability drives profitable portion of profitable growth, and this growth figure drives the growth component of profitable growth. Now, the results at the top of the triangle are explained by the results below. Each measure is explained by the two measures below it. So we can see that asset utilization and profit margin produce our calculation of profitability, and sales growth and margin change produce our EPS growth. And it is our profitability and our EPS growth that ultimately produce the profitable growth. So let's review the two measures of profitability. Let's start with asset utilization. That's sales divided by assets, and you want to get more revenue from the assets you have in place, and that's one way to increase profitability. Careful asset growth preserves capital, but beware, too tight asset growth means that sales may be hampered. Now, the next area, profit margin, is profit divided by sales. A strong profit margin shows that products that customers want are able to be delivered profitably. This is one measure of the strength of the management team, but again, beware, too tight cost control can constrict growth. Now let's review the two measures that drive EPS growth. First is sales growth, which is annual change in sales. This is the part of the EPS growth that is externally driven. Essential to grow the business, no sales growth means no customer demand, so we must have it. But growth without profit ends painfully. So let's look at the next measure, which is margin change, and that's annual change in net profit margin. So if margin was 10% and it went down to 9%, the change would be 1. Margin improvement comes from management team's focused effort. It means the company's getting more profit from every sale. But again, beware, too high prices or low costs could hurt sales growth. So now we go back and look at our triangle, and we can see that asset utilization and profit margin drive the profitable growth ranking, and sales growth and margin change drive the growth ranking. And the profitability and the growth ranking drive the profitable growth ranking and score. So what have you learned about how to read the triangle? Results are at the top of the triangle, and they're explained below. The company is ranked against peers on 6 different measures. 4 of them are on the bottom of the triangle. Asset utilization is the revenue generated from assets in place. Profit margin shows how good the company is at cost control. Sales growth proves that customers want the product. 4, a rising profit margin is an internal driver of EPS growth. Level 2 and 3 explain what is driving profitable growth. So what have we learned? We have a universe of 27,000 companies in 10 sectors. We rank them on the profitable growth score from 1 to 10, with 1 being best, against all sector peers of a similar size. We found that the share price performance of superior profitable growth companies beats their peers. And companies with large improvements in profitable growth ranks yield outstanding share price returns. The bottom of the triangle shows the strengths and weaknesses of the company and builds up to the profitable growth ranking. So there you have it. Become a better investor now and join us at babinow.com/join.